Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and Fintech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is Jeremy Sankwich, VP of Consumer Lending at CapEd Credit Union. He specializes in portfolio management, auto lending, residential real estate lending, home improvement lending, and financial counseling. He's led teams at a few credit unions over the last decade. CapEd is a federal credit union founded back in 1936 with locations throughout southern Idaho. Jeremy, thanks so much for joining us today.
Yeah, thank you for having me.
Why don't we start with, what do you think the biggest shifts have been in consumer lending trends over the past year or two? It's been an interesting market environment for sure.
Yeah, I think the biggest thing that I'm seeing is really related to the economy and inflation, especially with credit card debt. In fact, I think it was last quarter, credit card debt hit 1.166 trillion in America, which is an all-time high. And that's at the macro level, but we see it in our credit union, in our market. We see it with the applications. We see it with the number of trade lines on a borrower's credit bureau. It's not just one or two credit cards anymore. Sometimes it's 3, 4, 6, even 10. And so I think that the credit card utilization ratio, the credit card debt, that's really impacting a member's personal finance, their ability to qualify for loans. So that's the biggest impact. And inflation touches everything, but that's the number one thing that we're seeing in terms of consumer lending is on the credit card side.
Is that more within certain credit segments, geographies, et cetera, or is it really across the board, across the entire customer base?
Yeah, it's pretty much across the board. You're always going to have your transactors with credit cards who they pay it off every month and they use their credit card to make all of their payments, buy groceries, purchase gas, whatnot, and they get their rewards for it. And they have a good relationship with credit cards. But what we're seeing is that there's a lot more balances that are growing, and it's not, people are kind of letting it get a little out of hand in some cases, especially in those lower credit tiers. As you know, the credit score is really impacted by a person's utilization of credit card debt. And so that's why you tend to see that in the deeper credit tiers, mainly because those two things are related. One is causing the other.
Inflation obviously is starting to temper. Is this something that you saw first happening a year ago and it's kind of flatlined in the last 3 months, or do you still see these balances rising and the perceived risk of those balances rising?
Yeah, I think the perceived risk didn't really start kicking in until 2023, early 2024, but we definitely saw this in late 21 and into 2022. Kind of call it revenge spending. People were locked in, not able to go out and spend their money. They were, not allowed to go. It depends on what market they were in. I was in Washington State at the time, and there was a lot of rules in place about going into certain grocery stores. A lot of stores were shut down, a lot of small businesses. And so as soon as that started to open up after the pandemic, you started to see that tick up in spending, especially on the credit cards. And then inflation was a huge driver. When the cost of living increases, when groceries are more expensive, when gas goes up, when just your everyday purchases are more expensive, that's going to have a huge impact on that credit card balances. So that's what I would say as I've seen it kind of begin in that late 21, all through 22 and 23. And even though inflation is really starting to kind of come down a little bit, the balances aren't, because they were put onto people's credit card balances, during those last couple of years.
And obviously the Fed has raised interest rates quite considerably, or they did during the really rapid rate hike cycle. One thing that we saw was a lot of the good borrowers kind of didn't spend, right?
Yeah.
And so you basically end up with a higher proportion of bads within the portfolio purely because of the interest rate environment, of the perception of prevailing interest rates. Is that a dynamic that you guys also dealt with, and how has that affected your portfolio?
Yeah, our portfolio is, it's pretty healthy. It's seeing a lot of the same trends with the delinquency ratios increasing in credit cards. One of the other trends that I'm seeing in the portfolio that we begin to research a lot is we're seeing a lot of long-time borrowers, people who've had their credit card with the credit union for sometimes 10, 15, 20 years, going into serious delinquency and default. And a lot of that is bankruptcy related. And so that's something that we try to be as proactive as possible with our borrowers. And, we do anything that we can to help them out, not just with that one trade line, but holistically. Is there something that we could come alongside them with education and resources? Because sometimes what they're dealing with isn't just that credit card, it's something else related with their personal finance. Sometimes it's medical, sometimes it's being on fixed income. The cost of rent has increased a lot. So there's a lot of things hitting our consumers across the country in our market as well. That's really impacting their personal finance.
Yeah, I mean, I know one of the trends during COVID was, and particularly you had the people from California moving into southern Idaho. My guess is home prices went up, and that really had a dramatic impact on, what you paid for rent 10 years ago is very different today after probably a lot of migration to that Boise Meridian MSA.
Yeah, that's exactly right. There's a lot of folks in California, they did everything right. They purchased their house 15, 20 years ago. They kept that same house. They've been living in it for 15, 20 years. It's appreciated to the point where they can afford to buy their own home, but they have so much equity in that home that when they sell it and they move to southern Idaho, they pretty much can buy anything they wanted with cash 3 years, 4 years ago. And these are not wealthy individuals. They're just working class people who kept the same house for long enough that it appreciated to the point where they move into a less expensive market. And so that's what really impacted the southern Idaho market. The same is true for other regions in the country where there's been a lot of migration there, is you start to see those home prices tick up. And so that's definitely been an impact for us, not just on our real estate portfolio, but also in our consumer lending portfolio.
Right. Because it is interesting. I mean, if you've had customers for 10, 15 years and this is the first time they've defaulted, clearly something's going on in the market.
Yeah.
What's the job market like in Boise right now?
It's very strong. There's a lot of growth. There's a lot of the trades are very busy. Especially in this last summer cycle. The state manages our finances very well at the state level. So a couple of years back when our kids just started getting into school, I was very pleased to hear the governor say that they had a budget surplus. Yeah. And they were taking that surplus and applying it into the education environment. And that was going to teacher grants. That was going to programs at the school level, grants to help underserved or maybe at the lower means be able to afford some trade schools, get into higher education. So there's a lot of things that have been done here, I think, correctly. And it helps when you have a budget surplus instead of raising taxes to try to fill holes.
Yeah. And rates have come down, inflation has come down. Mm-hmm. Are you seeing any kind of promising green shoots out of the portfolio in the last 3 months, or do you think it's still too early to tell how that's going to impact the customer base?
Yeah, well, as a credit union, one of the big components that we have specifically as a credit union is that our members a lot of times will come to us first for some needs. And one of those things is refinancing. Yep. So you'll see a dynamic in the industry, especially in the credit unions, where there's going to be the great refinance swap, if you will. And so members are aware when the Fed lowers rates and it hits the news cycle, people start to be conscious of it. And it's free to refinance an auto loan. There's no barrier to entry with that. There's no closing costs like with the mortgage. So as the rate cycle the yield curve starts to move back down, the refinances start to pick up. Mm-hmm. And so that's an impact on our portfolio because we want to protect those loans. We have to be careful that we don't proactively reprice our entire balance sheet on the asset side, but we also want to retain these members because that's our relationship with them. And so that's going to be probably one of the biggest impacts of 2025 as it relates to auto lending and the rates going down is that dynamic, is the refinance boom.
And so related to that, like, what's your perspective on the role that fintech lenders play? Clearly, the consumer lending environment has evolved a lot over the last 15 years that you've experienced.
Hmm.
How do credit unions partner with and or compete with fintechs? And then there's also been a lot of consolidation within the big banks. And
Yeah.
so how are you guys viewing kind of the competitive environment today, and what role, like I said, fintech plays versus credit unions?
Yeah. I think there's been a big shift in that perception of fintechs and credit unions, probably in the last 5 years, not overnight, but it's definitely occurred in the last 5 years. And I was really blessed to be working with some really high level strategic leaders early in my career, and they were forward thinking. And so I saw fintechs as not someone to be competing with or these new entries into the marketplace, but we offer 130, 140, 200 different products and services as a full service financial institution. And we do some things better than any other competitor, but
Right.
there's a lot of things that we don't do better than the rest of the market writ large. And
Right.
that's what fintechs do. They usually offer one, two, or a very small number of things, but they do it exceptionally well. And
Right.
so that's an opportunity for credit unions to strategically partner with these fintechs, because at the end of the day, it enhances the service that we provide to our members. And that's what a credit union is there for, is their members who own the credit union. So I think that's been a lot more adopted in the last 5 years. You see it at the national level and the regional level. I'll give you two examples. ACU, America's Credit Unions, that's our nationwide trade association. And then our regional trade association called Go West. They not just allow these fintechs and try to encourage them to come into their conferences to be part of the trade shows, but they try to align these different fintechs with credit unions that they know are having certain needs in certain areas of their service. And they even go a step further in the last few years. They've started to invest in fintechs. They're starting to partner with them to help them prepare whatever it is that they're designing or trying to stand up, to be prepared for the credit union ecosystem. And
Right.
so that's the biggest shift I've seen in the last 5 years. Is it's not the old curmudgeons that are just like, I don't want to deal with these tech companies. They're competitors. They're not banks. Why are they not regulated? You heard all that 5, 6, 7 years ago. I really don't hear that anymore.
You think that's because the like credit unions like yourselves are like, how do I provide the best products and services to my customer?
Yeah.
And related to that, there's some things that fintechs will never be able to do. So
Yeah.
here's your chance to kind of brag about, like, what
Mhm.
does CapEd do really well that a fintech is never going to be able to do?
Well, I'll tell you just something that's very personal to me. I don't know if this is the exact right answer, but it's something that's a passion of mine since I've been in lending. Is as a credit union, we serve a community, and it's a community of people of all different backgrounds, and they have financial needs. And as a credit union, sometimes borrowers come to us and they have a need. It might be an auto purchase, refinance, could be a mortgage, whatever the case is on the lending side. And some of them aren't qualified today. Some of them get declined, others get countered back on their requests because they're not qualified enough. And one of the things that credit unions are known for is stepping in. And we don't just say no to these borrowers because we have a profit motive. And if that borrower doesn't qualify, then there's no reason for me to work with them because I can't generate income off of this transaction. But
Right.
instead, as a credit union, our entire mission is people helping people. And so you see a lot of credit unions, CapEd's one, there's a lot more across the country where they engage these members in financial counseling. And they step into these borrowers that might be told no today, and they say, let's not send you packing to the next guy to go ask for, this loan and inquiry, but instead let's stop that cycle and let's coach them into qualification one-on-one. And so
Right.
that's something that credit unions do. Now, there are fintechs, there are other organizations in the country that do financial counseling, local, regional, whatnot. But there's a very unique relationship when someone comes to their credit union and the lending department they're speaking with is the ones that step in and really help coach them into whatever it is that they need. And
Right.
that's something that I think a credit union is known for. That's a credit union difference. And it's really not based on, our heart or trying to be, better than anyone. It's based on our structure, being member owned. And that's what I would say is the credit union difference.
And would you perform that service for someone who had no relationship with CapEd prior to that?
If there's an infrastructure there, yes. I've done that
Yep.
before at a credit union that I used to work for. We set the program up and we scaled it, and we got it
Yep.
to the point where it's not just our borrowers that we're helping coach into their financial goals, but there's a lot of other partners out there. Fintechs
Yep.
perhaps could be one of them, but single service lenders like mortgage brokerages, they don't offer consumer loans. They don't offer debt consolidation loans. They don't offer these other types of services in banking. And so
Right.
there's a lot of symbiotic relationships there with financial counseling. And again, I think that's one of the biggest differentiators for a credit union is not necessarily the counseling itself, but it's the reason why we're able to do that and still be very aligned with our mission and our vision.
Yeah, that makes sense.
Yeah.
Well, things have been a little different since the first week of November with the
Oh,
presidential
yeah.
election.
hmm
Also, we have continued rate cuts. Like, well, what's your take on what's going to happen with the regulatory environment, how the change in the administration could impact your business and your customers?
Yeah. Well, let me start with this change of leadership in the country. I think that it's going to be a good thing for credit unions, for banks, and whatnot, if what we've been hearing is going to be what takes place. I think when we hear about regulatory environment and bureaucracy and inefficiencies, I mean, that's kind of speaking the language of fintechs, where you guys are in San Francisco, is there's something to be said about efficiency. There's something to be said about getting good return on your investment, and that's our world. But when you think about it as a consumer and as a taxpayer, are we getting a good return on our investment? And so some of the stuff that I'm hearing is kind of a non-political guy, but very engaged in policy and in my industry. I like what I'm hearing there if they're able to get that done.
Right.
However, it's going to come with a lot of disruption. There's going to
hmm
be a lot of headwinds to trying to unravel layers and layers of bureaucracy. And so I think time will tell in that, but I think that's a positive. I think a negative would be I've heard some comments about capping credit card interest rates at 10%.
hmm
And I think that President Trump is good at having, moving that Overton window in negotiation and maybe saying something that's like 10% might be a little extremely low. But what it's done is it's caused the nation to draw attention to credit card debt.
Right.
And for that, that's a positive. But if we're serious about a policy of capping interest rate at 10%, that's going to have a big negative in the
Right.
economy. It's going to limit access to credit because we as lenders, we have to price our loans for the risk. And if we can't price for that risk, we can't offer that product.
Right. And so, I mean, given the volatility that you kind of expect or you just talked
Yeah.
about, how are you going to manage through that when making decisions at your organization in the next 12 months, for example?
Yeah. One of the great things about, at least in our region where we are with credit unions, is that we have a trade association, Go West, and they're very engaged in the political world and the regulatory world. And they have very strong relationships with policymakers where they're able to know what's kind of on the docket before House bills are presented, before Senate bills are presented. So they keep us as the boots on the ground strategic leaders of our credit unions very well informed of things that we need to know. And if you have a 2,000-page bill, what do I need to know about how that's going to affect me here in Idaho or as a federally chartered credit union? And they do that very well, and they engage with not just the policymakers in DC, but they have regional representatives in each of the states that engage at the capitals within the states. So we stay very well informed. We don't have to personally go and read through all of this stuff and stay that up to date on what's being discussed because we have work to do managing a credit union, and they do that on our behalf. So
Yeah. That is
yeah,
one of the things that's impressed me the most about the credit union community is the
yeah,
level of communication and cooperation.
cooperation.
It
Yeah,
really does feel like you guys, it's more about cooperation and serving the customers than necessarily competition.
yeah. I think that's why you see such a big partnership with the fintechs because some of these founders and managing teams at these kind of either large fintech companies or maybe they're just trying to start up is a lot of times that mentality that has an idea and wants to go take the risk of trying to execute on it, they tend to be very collaborative.
Right.
And once they rub shoulders with credit unions, you're not going to find an industry more collaborative than the credit union movement. So
Right.
I think there's this natural affinity to adopt these relationships as business partners and not look at each other as competitors.
And then let's hope they find a good balance between removing friction, which
Mhm.
makes it easier for your customers to get the services they need, but also making sure that there's still strong consumer protection laws and striking that balance. It feels like over the last few years, it's shifted a little bit more towards more friction, and it looks like the tide is going to be turning back to a little bit less friction. But again, we need to make sure that we're delivering good products and services to customers and not taking advantage of them.
Yeah, totally agree. Yeah.
Yeah. So in terms of friction, another friction that exists
Yeah.
is IT systems and everything else. How are you guys investing in automation, other systems to more efficiently deliver products to your customers, but also in a delivery method that people are used to engaging with, right? I would assume that people go into the branches less frequently than
Yeah.
they used to, which has been a trend for the last 15, 20
Yeah.
years. But what kind of investments are you guys making right now to be prepared for that?
Yeah. Well, I noticed that you didn't use the buzzword AI, but that
Yeah.
is something that wherever you go, that's what's being talked about. And you guys live that. You guys are adopting it. You guys use that so well. And I think that what credit unions are tending to start to invest in, it's not just the IT side anymore. That's usually the folks in the building that were talking about AI in the early days of this new emerging technology, data analytics, predictive analytics. But now it's everyone talking about it. So us lenders are starting to adopt it. I'll give you an example is on credit risk underwriting is we have two kind of criteria that we look for like at a high level in terms of underwriting a loan. We have loss given default, and then we have probability of default. And typically what you're only looking at, and not even in a holistic way, is probability of default. That's your credit score, that's your credit history, the ability to repay, does it budget out with their ratios, etc. But there's a lot of room there to increase that. But we're not even talking about what is the loss given default.
Right.
And there's these AI technologies that are being able to, they're very much widely used now in the credit union space. And
Well,
they
what is
sit on
just for our listeners,
Yeah.
what does loss given default mean?
Loss given default is if this loan were to go into default and I had to take it to, say, an auto loan, for example, I'm going to have some costs associated with repossessing the vehicle.
Right.
And I need to take that vehicle to an auction. I need to recover. I need to liquidate the asset. And at the end of the day, I'm definitely not going to sell a vehicle at auction for as much as someone's going to purchase it at a dealership, which is retail. And so there's a discrepancy between retail and wholesale. And then you have your loan balance, which is somewhere in there in the middle. So looking at the risk of a loan, looking at the risk of the asset itself, the collateral that we're lending against, some of these technologies are looking into things like what's the amount of vehicle collisions that take place in a given market? What's the depreciation cycle and trend of this kind of vehicle versus this kind of vehicle?
Right.
And some of them are plugged into your portfolio. So they have performance data of your portfolio feeding that information. And it's all being curated, not at my desk so I can pull a report and go present it to my board. It's all being curated real time at the point of decision.
Oh, interesting.
And so it's not just able to decision alone, maybe with a little bit better credit risk analysis, but in some cases they're able to price the loan appropriately in adherence to different lending regulations and fair lending.
Right.
And that whole feature is something that's really starting to take hold in all types of lending, fintech, banking, and even credit unions. And so that's something that we're looking into real close because, like you say, friction. If I have to pay an underwriter to take 10 minutes to underwrite a loan and then move it to the next step and then describe the decision to the processor to relate to the member, I mean, that's not necessarily friction in the traditional sense. But if we can have instant decisioning
Hmm.
then whether it's the partners that are sending us loans or the members themselves applying, that instant decisioning in a very trustworthy decision is
Right.
a big value add for the member. It's a value add for our business partners, and it's of course a value add for us who are managing a portfolio.
Right. Right. And so that's the decisioning process. How are you
Mhm.
using that data to manage the portfolio itself and delinquencies and how you interact
Mhm.
with customers and
Mhm.
so forth?
Yeah, as far as the interacting with customers, there's a lot of, for us internally here at CapEd, we're looking at online account opening. We're looking
Yeah.
at online origination of loans. And that's probably the biggest opportunity to reduce friction for a credit union. Because if someone's already taken the time to drive to your branch, walk in the front door and sit down with someone, they're not necessarily as concerned about friction to the degree of getting an account open as the
Right.
person who goes online and they want the experience that they receive from Amazon. They want the experience that they receive from using Google and finding information. So the consumers are trained to have a good online experience. When they come to CapEd, do they get that? So that's one of our biggest projects in 2025 is rewriting, redoing, partnering with third parties to
Yep.
help collaborate and create an online account opening process that still works just like it does today, but works with the expectations that the online consumer expects.
And is that being delivered by your current technology providers rolling out better
No,
technology, or are you working with new entrants into the market who
yeah,
are delivering it in a more efficient way?
new entrants in the market that are delivering in a more efficient way. Exactly right. Yeah.
Well, it's probably a matter of time before the bigger technology firms end up buying those companies then.
That happens, unfortunately. And then what you had turns into something that you wish you didn't have. So we really like working with, we may not be the earliest of adopters and working with someone that doesn't have a single credit union client and we're their first,
Yep.
but we like to be emerging. We like to be there at the front end of some of these
Right.
things. And our chief technology officer is very forward thinking. He's very engaged in the industry, very engaged with the technology, both inside of credit unions and not. And
Yep.
so I think we have a good mix of balancing the risk of what if this, doesn't work,
Yep.
along with the, hey, we know this works because this company's been in the industry for 50 years.
Right. Yeah, it's one thing I've learned that the more of these integrations you do, the more you can better identify which are like actually have real substance behind them and which don't. You know how to ask the right questions. And so
Yeah.
as the chief technology officer, you definitely want someone with that experience of a lot of different integrations, which means you probably had to fail a couple times in terms
Yeah.
of projects, but you take that learning and build a better solution in the future. Do you
Yeah.
think technology, so credit unions have been losing market share in the auto space recently.
Mhm.
Is that more capital, structural, technology? What do you think's been a driver of that, and what do you anticipate will kind of change that trend? Because credit unions have been such a strong participant in that market.
Yeah. I think the only thing I could speak to in terms of the market share side on the macro perspective is credit unions still are the top lending partners when it comes to used auto.
Yep.
So still have very good relationships with the independent dealerships. There's technologies that are in place that are very easy for dealerships to use to send loans through to credit unions at the independent dealership level. So we're still, as far as quarterly production, still leading in used auto.
Yep.
In 2022 with new auto, we had this one-time bump to be the top lender
Yep.
in 2022, and we've since receded back to kind of more historical norms. And that's kind of helped drive some of our market share down
Yep.
writ large, is because there's been a lot of transactions, there's been a lot of new vehicles entering the
Yeah.
marketplace.
No,
So
that
it kind
makes
of
sense.
dilutes the pool. But
Yep.
yeah, the captives are back number one. They've
Yep.
really re-entered the market here in the last year.
Yep.
Banks have gotten back into the auto lending game and the short-term loans. So we're back to third place
Yep.
on new auto.
Yep. Yep. That makes sense. So what
Yeah.
asset classes are you excited about within your portfolio? Where do you want to make investments? I mean, clearly you need to monitor your existing portfolio and make sure you're not losing customers.
Yeah.
But if you think of the big trends, mortgage refi was one that
Mhm.
you threw out. Where are you staffing your team to be able to accommodate volume? Where do you expect to have the biggest growth areas in the next 18 months?
Yeah, auto refi is where we're starting to staff up. We really want more mortgage refi, but we're waiting for the rates to react to what the Fed did. They haven't reacted yet. I think what we're really pushing towards in 2025 is controlled growth, balanced growth. We're not alone here as credit unions, probably not even with the banks. Is we saw a very large amount of growth on the balance sheet through 21 and 22. And so that growth depleted through 2023, and then deposits became hard to attract.
Right.
And so from a lender perspective, as a managing a balance sheet, I can only lend what capital we have, what deposits we have from our members, and the available liquidity to deploy those in our assets as lenders.
Right.
So I think that's the biggest push for us is member growth and deposit growth in order to kind of the cart before the horse, in order for us to be able to aggressively grow again in lending. So right now we're just focused on the number one thing, which is making sure that any member that comes to us through a business partner like a fintech, that comes to us through our branches online, that they don't just walk away feeling like they received something valuable, but they walked away feeling valued. And that's our number one push right now. And that translates and manifests itself in member growth and deposit growth and loan growth.
Right. Anything that you're particularly worried about next year?
In the next year or two, a little bit off the lending subject per se, but this is kind of a trend that I'm seeing that you might find interesting, is that there's been kind of an increase in this last year. I shouldn't say kind of. There's been a big increase this last year, and I think it's going to increase a lot into next year and 2026, is CEO retirements and top leadership retirements.
Oh, interesting.
So there's been a lot of, we have a lot of credit unions with longtime leaders, longtime CEOs and top executives, and they've been in place as a top executive for a very long time. And a lot of them are starting to hit retirement age and choose to retire. And so there's going to be a mass transition across the industry of some of these longer term leaders who've been CEOs and top executives for a long time. And there's a lot of younger leaders who've been waiting for a while to have the opportunity to be a CEO.
Yep.
And they've been in the VP level, the C-suite level. They've been executing the vision. They've been the boots on the ground, working with their teams, doing all the stuff we just talked about, the AI, the enterprise risk management, the technology, the lending. And you're going to start to see a lot of this next generation leaders step into that role of CEO over the next year to 2 years. And that's going to have a huge impact on our industry in a very positive way.
Yes.
And, we've had a lot of amazing icons of leadership in our industry. And it's sad to, know that you're not going to see some of these leaders at conferences. Hopefully they come back and they speak and they keep investing in guys like me.
Yep.
But at the same time, you're going to have a lot of new leaders step into CEO positions in credit unions over the next 2 to 3 years. And I think it's going to be a really fun wave.
Do you think it's going to drive more combinations amongst credit unions also?
Combinations?
Just the merger of credit unions due to leadership gaps and so forth.
Yeah, that is a risk. That is definitely a risk in our industry. I actually wrote some notes down here. In 2020, we had 4,845 federally chartered credit unions in the country.
Yep.
2024, we're down to 4,572.
Oh, wow.
That's 273 organizations. Credit unions don't generally fail. What happens is they get merged into, most of the time, larger credit unions.
Right.
So the risk of what I just shared with you, the risk of that is that if boards aren't prepared with succession planning, if CEOs aren't prepared with bringing up and developing the next generation of leaders, then at that time of retirement, if there's an unpreparedness with that transition, sometimes it's easier to merge into a credit union at that time.
Yep.
And that's a big risk because the less small credit unions that we have in these local communities that banks have pulled out of, the harder it is for the consumer. So small credit unions are a foundational pillar I think, of personal finance in our society, especially as these smaller rural communities, we've seen big banks leaving,
Right.
those branches pulling out. And so I think that protecting those smaller credit unions, I think making sure that that trend of retirements and board succession planning, there's a lot of companies in our industry that are really in tune with this, and they partner with boards and help to develop those plans.
Yep.
And that's exciting to see, because this industry, the sky's the limit with the next 5 years.
Yeah.
And I think that all of those factors combined are going to be far more outweighing any of those risks.
Yeah, no, I agree. It's a great opportunity for you, Jeremy. And frankly, CapEd, it seems like you guys are positioning yourself very well. So I want to thank you for being a guest on Community Lending Perspectives podcast, brought to you by Upgrade. For the listener community out there, we welcome your emails to investor@upgrade.com on guests and topics. Be sure to subscribe for notifications about future episodes. Until next time, I'm your host, Jeff Bogan.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.